Are you ready to uncover the truth behind Wayfair's 20% move up in one single day? With the pandemic reopening causing revenue to plummet, the company has decided to lay off 1,000 workers to cut on costs. It's now more important than ever to remain informed on the reality of this giant in the home goods space. Welcome back to Common Sense Finance. I hope you're doing fine. In this video, we will take a look at Wayfair, this giant in the home goods retail space, and we will try to take a look at their numbers, see why they decided to lay off 1,000 workers of the workforce, and see which is the impact or which will be the impact of this decision into the company's expenses, earnings, and future prospects. Sounds good? You don't want to miss on this video, so let's get into it. So really quick before we start, what are the 5 key factors that we want to look out in any type of investment that we made in this channel? So first of all, we need a strong competitive advantage. So we want a company with a business model that can defend itself from competition, so they can protect their margins, their market share, etc. into the future. So we want to have a company that has a secured position in a particular market, in a particular segment, etc. Secondly, we need revenue and earnings to be growing. So these are the 2 most important metrics of any type of business: the top line revenue, how much they are able to generate in sales, and the earnings. So if they have good margins, they will generate a good level of earnings. That is important to know as well, because that is the bottom line, that is the net result that the company generates year after year, quarter after quarter, etc. Number 3, we need a strong free cash flow and equity growth. So free cash flow to equity is a really important metric to us investors, because that is the economic return that we get when we own equity. So free cash flow is the actual free cash flow that a company generates from its cash flow from operations, so the amount of net cash that they produce each year as from their ongoing operation, minus the capital expenditures, so the reinvestment that they do in the business. That is our economic return that we get as equity stakeholders. Number 4, we need low debt. So we want to look out for balance sheets that are not over leveraged. We want to look out for companies that are in a good position in terms of debt, because interest payments are a burden and they can really quick become a menace for business. And number 5, and most importantly, we need strong return on investment. We will do a forecast of the business under a very conservative assumption, and the IRR that we get from our model, so the internal rate of return, must be above 10%. That means that the stock is undervalued, and that, according to our model, will all outperform the market. Wayfair is an online retailer that specializes in home goods. They sell a wide variety of products from home, such as furniture, decor, kitchen appliances, etc. They offer a vast selection of products from various brands and designers, and they make it easy for customers to shop by room, size, etc. However, this is the case of a company that lacks a competitive edge. This is primarily due to low pricing power, because this is a highly commoditized market, and consumer switching costs that are not high enough. So the problem with this type of companies is that they do not have a offering that is purely unique. They have a lot of competitors, so the market is commoditized. So all competitors in the market offer a similar offering. So customers have a really small switching cost. So for example, I am a buyer at Wayfair, but I can simply switch from one month to another to Target or to Bed Bath & Beyond to buy my home appliances or whatever it might be. So to me, there is no cost in switching my furniture provider, but for these companies, that same low switching cost that customers have represents a huge risk for the business, so they don't have this competitive edge that other type of companies would have. Also, another problem with Wayfair is that they constantly outspend their competitors. Wayfair has consistently outspent its peers, spending an average 11% of their revenue for the last 5 years in advertising. That is compared to a 7% of Williams-Sonoma and only a 5% for Bed Bath & Beyond. This outspending level has been a key factor into determining their very poor profitability, and is the main reason as to why this week, the company has announced that it will be laying off 1,000 workers. We'll try to take a look at the numbers right now so we can come up with an idea of the effect of this decision into the financial future of this company. Starting as always with revenue. Revenue has grown with an stellar growth from $600 million in 2012 to $13.7 billion in 2021. That is a 33% annualized growth rate. That is huge. The number of customers, of active buyers, also has some stellar growth. It grows from 2 million customers in 2013 to 27 million customers. That is an annualized growth rate of around 30%. In terms of the revenue per customer, they have been growing that number consistently each year. So we started in 2013 with $437 per active buyer, and by the end of this period, so in 2021, they have reached $507 in revenue per customer or per active buyer. Now, in terms of EBITDA, they have been mostly unprofitable. So for the last 8 years, they have posted negative EBITDA. We'll see why. They have this huge level of expenses. In 2020, that outlier year, they were able to generate $500 million in EBITDA or a 4% margin, but that quickly fell down to $7 million in EBITDA for 2021. And now the problem this company has experienced over the last 2 years is that they have been able to post amazing growth. They had this huge outlier year 2020 where they posted a huge revenue, an all-time record, $14 billion in revenue, amazing. But now cost of revenue and the operating expenses are also higher. And the problem with this is that by 2021, they have seen that with the pandemic reopening and with the economy returning to the new normal, they are not able to continue posting that same revenue growth, but expenses remain the same. They have now lower than ever margins, if they have any, because they have not been able to post any positive EBITDA. They need to find a way to lower those expenses. And the way they choose to do that is by laying off 1,000 workers and expecting to save around $750 million per year in operating expenses. In fact, if you take a look at the revenue per customer as opposed to the expenses by customer, which I put in this graphic, you see that today, in 2021, they can have a revenue per customer of $507 per customer, as opposed to having a total expenses of $511 per customer. If they lay off 1,000 workers and they cut down $750 million per year in expenses, that expense per customer number drops to $483 per customer, so they will be able to post a net profit. Now, if I take a look at their free cash flow, so cash flow from operations grew from only $4 million in 2012 to $410 million in 2021. That is a stellar growth. That is 55% annualized. Capex has grown from $8 million in 2012 to $100 million in 2021. That is a 29% annualized growth rate. And the interesting thing is that they have been printing shares. So the share outstanding count grew from 4 million shares in 2012 to 100 million shares in 2021. There is an annualized increase in the number of shares of 10%. They have been printing shares mainly to fund the business, because we have seen that they are not profitable. So somehow they have to fund the business. That has been growing, and the equity part of the business, so the number of shares outstanding, has been growing as well. Of course, free cash flow to equity has been for the most part negative. Now, in order to forecast this business, I'm assuming that the company will be able to generate a revenue growth of around 3% per year. I think that is very reasonable. They have been growing at a far higher rate, but now that they are getting more and more consolidated, I don't believe that they were able to post the same stellar growth. So analysts are estimating that for 2022, they will post a revenue drop. From that on, I'm assuming that the company will grow at a 3% per year. So by the end of the period, so by 2031, I get $15 billion in revenue. For EBITDA, I'm taking the word from management saying that they will be able to post positive EBITDA in 2023. So by the end of this period, I get $1.1 billion in EBITDA. I'm assuming that the growth from cash flow operations and capex continues around the same. So cash flow from operations, as they are able to post net profit and EBITDA positive margins, I think cash flow will follow through. So in terms of the free cash flow per share, I get a free cash flow per share that grows from $3.37 in 2022 to $4.21. Now, if I put all of this into a calculator, I have an EBITDA of $1.1 billion by 2031 that I multiply by a long-term multiple of 25. I'm assuming that they continue to have some level of debt in their balance sheet, so my net debt to EBITDA ratio is 1.5, so I'm subtracting $2 billion, almost $3 billion in debt to the final enterprise value number, and I get a market cap of $24 billion by 2031. I divide that by the shares outstanding, so I get a stock price of $92.27. And I put all of this into an IRR calculation. So I can buy the stock today for $46.79, and I get a string of cash flow that by the end of this period sums up to almost $44 per share. My shares appreciate in nominal value by 89. And the total IRR for this model is 16%. So 16% IRR for Wayfairs. I think that it's possible. I believe so. If they are able to pull through these cost reducing policies, if they are able to execute, that is the key word, execution. If management is able to cut down on cost, if they are able to post profitability, net profit, so bottom line profitability, EBITDA profitability, if they are able to grow cash flow, which I think goes hand in hand with profitability. If that is so, I believe that this company is a bargain right now. But under my point of view, I think given the level of execution that is demanded, I think you should ask for way more than 16% because that is your margin of safety. This has been Common Sense Finance. I hope you have enjoyed, and I'll see you next week.